Very good morning, students. We are in the chapter Amalgamation. We already started problem number 1. But before directly proceeding with problem number 1, let me give a quick recap. In past couple of lectures, what we discussed, just I want to give a recap for within 5 to 10 minutes. Reconstruction is the process of rebuilding of existing financial statements. The main reason is the existing financial statements are not depicting true and fair picture due to occurring of continuous losses. At that point of time, company have two choices before going to go for liquidation. Choice number 1 is external reconstruction. Choice number 2 is internal reconstruction. In case of external reconstruction, liquidation of existing company is going to take place. A new company is incorporated to take over the existing company. In case of internal reconstruction, without liquidation of the existing company, internally the existing assets and liabilities are readjusted. I mean to say, reassessment of liabilities, revaluation of assets, reduction in paid up value, or compounding activities with various creditors is going to occur in case of internal reconstruction. One more thing, court approval should be necessary for conducting the internal reconstruction activities. After completion of internal reconstruction, and reduced reward should be needed to add at the time of presentation of balance sheet. So now, for external reconstruction, the classic example is amalgamation in the nature of merger. But till now, we not discussed amalgamation in the nature of merger. So I told you amalgamation is broadly categorized. Now in the chapter amalgamation, we are going to discuss problems based on pure amalgamation, problems based on absorption, and problems based on external reconstruction. Because for the purpose of providing accounting treatment, there is no difference between amalgamation, absorption, and external reconstruction. There are only two types of companies evolved. One is selling company, another one is purchasing company. So coming to the concept of amalgamation, two companies is going to merge and a new company is emerge. Simply a new company is incorporated to take over two or more existing companies is known as amalgamation. In case of absorption, one existing company take over another existing company. This is simply blending of one company and absorption of another company. In case of external reconstruction, a new company is incorporated to take over another existing company. So the objectives are quite different. The objective in case of amalgamation and absorption is maybe for getting the synergy benefit, maybe to increase the efficiency, maybe to increase the economies of scale, maybe to avoid the competition. But coming to external reconstruction, the objective is showing the existing financial statements at true and fair view. Now, in amalgamation chapter, what we are going to see? Accounting treatment in the books of selling companies, accounting treatment in the books of purchasing company, calculation of purchase consideration. One thing is sure, in the books of selling company, accounting standard 14 is not applicable. Generally accepted accounting principles are applicable. Such generally accepted accounting principles are related to closure of books of accounts. But accounting treatment in the books of purchasing company and for calculation of purchase consideration, accounting standard 14 is applicable. Sir, in case of closure of books of accounts, we need to follow 5-step approach. If you see here, the step number 1 is dismantling of balance sheet. Now, all of you, please, you can step into the shoes of the selling company. Now you are in the process of closure of business of the selling company. You should need to dismantle the balance sheet, assets and liabilities which are taken over by the purchasing company, closed and transferred to realization account at book values. If any particular asset or particular liability which is not taken over by the purchasing company exists in my balance sheet, you can open it separately. For which purpose? The asset you may realize in the outside market at appropriate time. You may repay amount to the liability holder as well at an appropriate time. Am I right? So just simply you can open separately for the time being. Then equity share capital, reserves and surplus, miscellaneous expenditure not written off, that is like fictitious asset, if any at all are there in your balance sheet, you can simply close it and make it transfer to equity shareholders account. preference share capital you can transfer to preference shareholders account. Then disbanding of balance sheet over. Step number 1 is over. Then step number 2. Sir, step number 2 is for purchase consideration due. The entry is purchasing company account data to realization account at the rate of purchase consideration. Now, coming to the discussion of PC, you need to calculate purchase consideration by providing a separate working note. What exactly the meaning of purchase consideration? Actually, as per accounting standard 14, amount payable by purchasing company to the shareholders of the selling company alone treated as purchase consideration. Here shareholders are both inclusive of equity shareholders and preference shareholders. But amount payable by purchasing company to the debenture holders of selling company is not treated as purchase consideration. That is the important point. And one more thing I told here, sir, what you are paying is irrelevant. To whom you are paying is relevant. I mean to say, to whom you are paying means if you are paying to the shareholders, I will consider it into calculation of PC. If you are paying it to other than shareholders, I will simply exclude in calculation of purchase consideration. Sir, what you can issue as a purchasing company, you can issue your equity shares, you can issue your preference shares, you can issue your debentures as well as cash. That's why whatever you want, you can issue, but whom you should need to issue is the main important thing here. Then we've seen different methods of purchase consideration: lump sum method, net payments method, net asset value method, intrinsic value method. In case of lump sum method, simply the ad hoc consideration is decided by the purchasing company. It is given to the selling company. Ad hoc consideration means the fixed amount. Next, coming to the net payments method. In case of net payments method, how to calculate PC? Amount payable to equity shareholders and amount payable to preference shareholders with the given information. If you can able to ascertain, then the method of PC is net payments method. But with the given information, if you are unable to ascertain how much amount you can payable to equity as well as preference shareholders, then the method of PC will goes to either net asset value method or intrinsic value method. Then in case of net asset value method, how to calculate purchase consideration? Assets taken over at the rate of agreed values less liabilities taken over at the rate of agreed values. Then you will get NAV, which is equal to the purchase consideration under NAV method. Now coming to the intrinsic value method, how to calculate purchase consideration in case of intrinsic value method? In case of intrinsic value method, purchase consideration is equal to number of equity shares in the selling company into intrinsic value per share in the selling company. Number of equity shares in selling company into intrinsic value per equity share in selling company. For example, if they asked how many number of shares issued as PC, whatever the method you are following, if they asked how many number of shares issued as PC by purchasing company to the selling company, you should always use the formula purchase consideration divided by issue price. For example, if it is under intrinsic value method, how many number of shares issued as purchase consideration by purchasing company to the selling company, then purchase consideration divided by on behalf of using issue price of the purchasing company, you may use intrinsic value per share in the purchasing company. That's why in case of number of shares issued as PC under intrinsic value method is equal to the PC. What is the formula for PC? Number of equity shares in selling company into intrinsic value per share in selling company divided by on behalf of issue price. We are using intrinsic value per share in purchasing company. So certain special issues also I discussed regarding the calculation of purchase consideration. In generally, PC is recorded at issue price only. PC is recorded at issue price means how many number of shares you are issuing as PC, you can multiply with the issue price, then you will get the total purchase consideration. But if management wants to decide that, or if management wants to record PC at par value, then you may calculate the purchase consideration in below way. What is that way? Number of shares issued as PC, multiplied with face value per share, then you will get purchase consideration to be recorded at par value. I already told you whether you are adopting the PC at issue price, whether you are following for recording of the PC at par value, impact is same. But till now, I didn't prove such fact. Maybe at the appropriate time, I will show how the impact in both the cases it is same. Okay. Next, coming here, accounting treatment in the books of purchasing company. So for the purpose of providing accounting treatment in the books of purchasing company, amalgamation is broadly categorized into two types. Amalgamation in the nature of merger, amalgamation in the nature of purchase. When an amalgamation is said to be amalgamation in the nature of merger, if all the below conditions are satisfied, then such amalgamation is said to be amalgamation in the nature of merger. Purchasing company should take over all the assets and liabilities. Purchasing company should take over all the assets and liabilities at book values only. Purchase consideration should be paid only in the form of fully paid up equity shares only. Shareholders holding not less than 90% share capital of selling company should become the shareholders of the purchasing company by virtue of amalgamation. Sir, the final issue is after takeover of the business by the purchasing company, the same business is continued. Am I right? Sir, here actually, just a moment, guys. Here, actually, certain exceptions are there. At that point of time, I intentionally ignored such exceptions. What are such exceptions? Just I want to inculcate right now. Please concentrate. Sir, PC should be only in the form of fully paid up equity shares only, right? Sir, for fraction of shares, you may pay cash. For fraction of shares, you may pay cash. What is the meaning of fraction of shares? For example, I calculated purchase consideration. Sir, it came around 6,555.50 shares. I cannot issue 0.50 share, right? For such 0.50 share, you can pay the cash. Sir, even if you pay for such fraction of shares, it will not become amalgamation in the nature of purchase. Why? Because, sir, just now you told that the PC is in the form of fully paid up equity shares only, but fraction of share, if you are paying cash, then is it amalgamation in the nature of merger or amalgamation in the nature of purchase? Still, it is amalgamation in the nature of merger only. One more thing. Shareholders holding not less than 90% share capital of the selling company should become the shareholders of the purchasing company by virtue of amalgamation. I told that point, right? Sir, for example, here two companies are there. The same companies I am going to continue. Concentrate, all of you. This is Rani Limited. This is Razu Limited. Before amalgamation, Razu Limited hold investments in equity shares of Rani Limited. For example, the total share capital of Rani Limited is 10 lakhs. Out of this 10 lakhs, I already hold 1,000 shares. 1,000 into, let us assume each equity share is 100 rupees. 1,000 into 100 means I already hold it to the extent of 1 lakh share. Out of this 10 lakhs, I'm already holding to that extent of 1 lakh worth in Rani Limited. Now, in the process of amalgamation, you need to hold the remaining 90%. I mean to say, in the remaining 9 lakhs, at least 90%. 9 lakhs into 90% means 8,10,000 should become the shareholders of the Razu Limited. So one student actually asked that query through mail. So that's why again I'm inculcating at the time of discussion during my revision. So shareholders holding not less than 90% share capital of the selling company should become the shareholders of the purchasing company by virtue of amalgamation. That is agreed. But this 90% I'm going to calculate other than those shares which already held by the purchasing company in selling company before amalgamation. At least 90% from the remaining capital should become the shareholders of the purchasing company. Hope you understand. Okay. Next, coming to the purchase method. Sir, in the books of the purchasing company, if the amalgamation is amalgamation in the nature of purchase, we should need to adopt the purchase method. The first and foremost entry is business purchase account data to liquidator of selling company at the rate of purchase consideration. Sir, business purchase means you are purchasing the assets and liabilities. That's why you need to incorporate assets as well as liabilities at agreed values. Then the business purchase should be knock off. Once you incorporate assets and liabilities at agreed value, then you can knock off business purchase. Now, if you observe here, business purchase is at the rate of PC. assets minus outside liabilities is at the rate of NAV. If you compare purchase consideration with NAV, then there may be a chance of PC is greater than NAV, or there may be a chance of PC is less than NAV. If PC is greater than NAV, you are paying the more amount over the benefit you are getting. That's why we can consider it as a goodwill. If PC is less than NAV, then you are getting a more benefit over the amount paid by you. That's why we can consider it as a capital profit, and which is a capital reserve. Sir, if purchase consideration is equal to NAV, there is no chance of occurring goodwill. There is no chance of occurring capital reserve. Am I right? Sir, when in generally purchase consideration is equal to NAV, in case the PC is calculated or NAV method, then PC is equal to NAV, then there is no chance of occurring goodwill or capital reserve. Next, sir, at the time of making payment of PC to the selling company, the entry is liquidator of selling company account debtor. Here you create a liability, right? That liability right now you need to discharge. Sir, in which form you can pay? You may So right, just a moment, guys. An unexpected error happened. So please bear me, all of you. I'm continuing. I'm continuing my flow. Please concentrate. Come back. So the entry is debentures of selling company account debtor to my debentures, that is to 10% debentures account. If you are issuing the debentures with premium, then you can credit the premium. Sir, if you are issued such debentures at discount, you can debit the discount on issue of debentures. Certain special issues already we discussed. Sir, in generally, in case of amalgamation in the nature of purchase, the reserves and surplus of the selling company is not taken over by the reserves and surplus is not taken over by the purchasing company. You know, right? So the purchasing company will take over assets and liabilities only. Purchasing company will not touch the reserves and surplus of the selling company. But if any statutory reserves exist in the books of selling company, to comply the provisions of the statute, I need to maintain such statutory reserves in the books of purchasing company after takeover. To maintain such statutory reserves in the books of purchasing company, I will pass one entry, amalgamation adjustment account debtor to statutory reserve account, which is shown as a positive balance under reserves and surplus. Amalgamation adjustment account will shown as a negative figure under reserves and surplus. Once the time period elapsed, the entry should need to be reversed, that is statutory reserve account debtor to amalgamation adjustment account. Sir, one more important issue we discuss. In case of intercompany owings in between selling company and purchasing company, we should need to eliminate such intercompany owings by passing a entry trade payable account debtor to trade receivable account, loan payable account debtor to loan receivable account, bills payable account debtor to bills receivable account, creditors account debtor to debtors account. So for all type of intercompany owings, the entry will be same, that is liability account debtor to asset account. Next, one more thing, concept of stock reserve. Sir, whenever the goods are sold by purchasing company to the selling company, and such goods are ultimately lying in the closing stock of the selling company, then at the time of acquisition of such stock by the purchasing company, we should eliminate the unrealized profit lying in such closing stock by creating a stock reserve and by passing the entry goodwill account debtor to stock reserve account. Sir, so many persons ask why you are debiting the goodwill here. I clearly told such fact. Sir, the stock worth is, in my example, the real worth of the stock is only 10,000 minus 1,667, which is 8,333 is the real worth of my stock. But I am acquiring the stock at the rate of 10,000. That means you are paying excess of how much? 1,667 you are paying excess. At any point of time, if you paid the excess over the benefit you are getting, that amount should need to be debit to the goodwill. That's why I need to debit to the goodwill account debtor to stock reserve account. If at all, if you have capital reserve in your balance sheet or if any balance is there under capital reserve, you can set off this goodwill with capital reserve, that by passing the entry capital reserve account data to goodwill account. That means if at all capital reserve is there, on behalf of making debiting to the goodwill, you can directly debit to the capital reserve account, because if you debit to the goodwill, again you will cancel with capital reserve, right? So then goodwill anyway cancel. So that's why on behalf of debiting the goodwill, you can directly debiting the capital reserve. Nothing is wrong in that. So one more, the important and the last issue I discussed, which is realization expenses or liquidation expenses. Sir, if realization expenses incurred and paid by the selling company, in the books of the selling company, the journal entry is realization account data to cash account. In the books of purchasing company, there is no entry. Next, sir, if such realization expenses initially incurred by the selling company but reimbursed by the purchasing company at a later time. Sir, initially you are incurring means there is a cash outlay, but later point of time you are expecting from the purchasing company, then the journal entry is purchasing company account data to cash account. At the time of getting reimbursement from the purchasing company, the entry is cash account data to purchasing company. To be frankly speaking, there is no impact, but these two entries we are going to record at two different point of times. That's why you need to record. Next, in the books of purchasing company, what is the journal entry? Goodwill account data to cash account. Why in the books of purchasing company again goodwill debited? Sir, this is in addition to the PC you are paying. This is in addition to the benefit you are getting, you are paying. That's why the excess amount payment is for the purpose of goodwill. That's why you need to debit the goodwill account. Next, incurred and paid directly by the purchasing company. In the books of selling company, no entry, but in the books of purchasing company, goodwill account data to cash account. If you remember, in the books of selling company, I just only told 2 steps in the revision process. I ignored the remaining other steps. Up to PC due only I discussed. Then I calculation of PC, I jumped. You know the remaining steps, right? At the time of receipt of PC, the journal entry is cash account data, preference shares of purchasing company, equity shares of purchasing company, debentures of purchasing company to purchasing company account. Then the amount which you are getting as a PC along with the existing resources. I mean to say the existing resources means if any asset which is not taken over by the purchasing company, you can realize it in the outside market. Any profit or loss you derived, you can make it transfer to realization account. Then the amount of PC plus the cash realizations through realization of assets which are not taken over by the purchasing company, you need to distribute in a particular order. That is realization expenses, security creditors, unsecured creditors, preference shareholders, then final settlement to equity shareholders. But before making final settlement to equity shareholders, you should close the realization account. Profit or loss derived from such realization, ultimately you can transfer to the equity shareholders account. Then with the available resources, if you can make payment to the equity shareholders account, all accounts are closed. Sir, this is the in detail discussion what we made in the last 2 couple of lectures. Then we started problem number 1. Am I right? I'm already in the process of doing the problem number 1, but to continue my flow in smooth manner, let me open problem number 1 once again. Please all of you concentrate. I don't want to read the entire problem. I will read the crux of the problem and will continue my flow. Concentrate, guys. Y Limited acquires the business of Z Limited. We decided Y Limited is a purchasing company, Z Limited is a selling company. Now the balance sheet information is related to Z Limited. Share capital, equity share capital is there for 8 lakhs, preference share capital is there for 4 lakhs. Under reserves and surplus, if you observe in note 2, capital reserve is there, profit and loss account is there. Under workman compensation reserve, even though balance is 8,000, the liability part is 5,000. That's why 5,000 we consider as a liability. The exclusive reserve is only to the extent of 3,000. Under long-term borrowing, 6% debentures are there to the extent of 2 lakhs. What about remaining liabilities? Trade payables is there. Other current liabilities, which is interest payable on debentures, exist. Then if you observe under non-current assets, property, plant and equipment, coming to note number 4, 2 PPEs are there. One is land and building, another one is plant and machinery. Coming to intangible assets, 2 intangible assets are there. One is goodwill, another one is patent. What is the other information? Inventory, trade receivable, cash and cash equivalent. That is the balance sheet information. Sir, what about the further information? Y Limited was to take over all assets except cash and all liabilities except for interest due on debentures and to pay the following amounts. By seeing this sentence, we can simply conclude that amalgamation is in the nature of purchase. Because all assets and liabilities not taken over by the purchasing company, the first condition itself is violated. That's why we can simply treat it as amalgamation in the nature of purchase. In the books of purchasing company, you need to adopt purchase method. But method of accounting treatment, method of amalgamation is irrelevant in the books of selling company. Method of amalgamation is only relevant to provide accounting treatment in the books of purchasing company. Okay, come to point number A. 2 lakhs face value, 7% debentures of 100 each while limited. That means in purchasing company, for the existing debentures in Z Limited, for selling company, for the purpose, each debenture of Y Limited is to be treated as worth 105 rupees. Simply, purchasing company is going to issue debentures of the purchasing company to the debenture holders of the selling company. Now, I am going to issue 2 lakhs worth of face value at the rate of 105 per debenture means 2 lakhs into 105%, I am issuing the worth of 2,10,000 debentures to the debenture holders of Z Limited. But one thing is sure, amount payable to debenture holders of the selling company is not considered as purchase consideration. Next, coming to point number B, for each preference share in Z Limited, 10 rupees in cash and 9% preference shares of 100 rupees in each in Y Limited. That means preference shareholders of selling company will get cash as well as preference shares of purchasing company. For each equity share in Z Limited, 20 rupees in cash and 1 equity share in Y Limited. That means equity shareholders of selling company is also getting cash as well as equity share in Y Limited. But the market value of each equity share is 140 rupees. Now, after reading point number B and point number C, we can able to ascertain how much amount is payable to equity shareholders and how much amount is payable to preference shareholders. Then the method of PC is net payments method. But if you are unable to ascertain how much amount is payable to equity and preference shareholders, then the method of PC you may adopt either NAV or some other methods. Okay, come down. Expenses of liquidation of Z Limited are to be reimbursed by Y Limited to that extent of 10,000. Actual expenses amounted to 12,500. Out of 12,500, 2,500 expenditure is incurred on your own means. The entry is realization account to cash account. Sir, 10,000 is reimbursed by the purchasing company means at the time of initial incurrence, purchasing company account to cash account. At the time of receipt of reimbursement, cash account to purchasing company account. Sir, these entries in the books of selling company, then what is the journal entry in the books of purchasing company? Goodwill or capital reserve account to cash account. Just now we seen as a process of revision the entire accounting treatment related to realization expenses. Am I right? Then they asked the requirement calculation of purchase consideration. Provide journal entries in the books of vendor company and closing the ledgers. I'm not passing any journal entries. I will only make it happen through close that is preparation of ledgers, and I will close the entire business through ledgers preparation and journal entries in the books of purchasing company. Finally, we will see. We already seen in my OneNote calculation of purchase consideration under net payments method in the last lecture. Am I right? So this is the continuation of the last lecture. Almost it took 10 to 15 minutes time for me to continue with my flow. Now, accounting treatment, calculation of PC is which method here? Net payments method. Amount payable to equity shareholders in the form of cash for each equity shareholder 20 he told, and we are issuing one equity share. At each equity share is 140 rupees, that is 8,000 into 140, 11,20,000. Total we got 12,80,000. Now coming to preference shareholders, cash we are paying 10 rupees for each share, and for each preference shareholder is also getting one preference share. So total for preference shareholders 4,40,000 and PC is 17,20,000. Then accounting treatment in the books of selling company. Now I completed step number 1, dismantling of balance sheet. If you consider here, assets taken over transfer to realization at book value, liabilities taken over also transfer to realization account at book value. One more liability, which is workman compensation liability, some part of the reserve we treated as a liability. That liability is also taken over by the purchasing company. Cash not taken over by the purchasing company, separately open. Outstanding interest on debentures not taken over by the purchasing company, separately open. Equity shareholders, preference shareholders, separately open. Now all of you please concentrate. What is step number 2? PC due. What is the journal entry for PC due? All of you please tell me. Realization account data to purchasing company, or is it purchasing company account data to realization? Tell me guys. Purchase consideration due, purchasing company account data to realization account. Now in realization account, I'll start this by, what is the purchasing company here? Z Limited account. At the rate of PC, already there, the purchase consideration readily available, which is 17,20,000. So which is step number 2, PC due, purchasing company account data to realization. In realization by Z Limited, then where is the Z Limited account? Okay, now I need to open Z Limited account as well here. Concentrate. So this is Z Limited account. Not there. Now I am opening. So now concentrate. If in realization, it is by Z Limited, in Z Limited to realization. How much amount? 17,20,000. Step number 2 over. Coming to step number 3. PC receipt. In the form of PC, what you are receiving? Cash, you are receiving 1,60,000 plus 40,000. 2 lakhs you are receiving in the form of cash. Equity shares of Y Limited, you are receiving 11,20,000. 9% preference shares of Y Limited, you are receiving 4 lakhs. Now all of you please concentrate. What is the journal entry? Cash account data, equity shares of Y Limited account data, preference shares of Y Limited account data to Y Limited account. Sorry, this is not Z Limited. Sorry, yaar. I'm extremely sorry. Purchasing company is Y Limited, right? Not Z Limited. Okay, we are in the books of selling company, guys. We are in the books of Z Limited. So that's why I am opening the. Sir, sorry, is there any disturbance? Nothing else, right? Okay, fine. Concentrate. So in Y Limited account to realization account, 17,20,000. In realization, it is by Y Limited. I'll change this one as well. I'm extremely sorry. Okay. So PC due is over. Now let me write the entry for PC receipt. Cash account data, preference shares of Y Limited account data, equity shares of Y Limited account data to Y Limited. In Y Limited books, by cash. How much? By cash. Total cash, how much you get? 1,60,000 plus 40,000, which is 2 lakhs. Next, buy preference shares of Y Limited. Buy preference shares of Y Limited. How much you get preference shares of Y Limited? Can you please tell me, all of you? 4 lakhs. That is 9% preference shares. 4 lakhs you are getting. Next, buy equity shares of Y Limited. How much you are getting, guys? Equity shares of Y Limited? I think so, which is 11,20,000, right? Which is 11,20,000. Now, PC receipt is also over, but the simultaneous posting need to be required in Y Limited by cash, in cash account to Y Limited. In cash account to Y Limited, which is 2 lakhs. Next, 2 more accounts need to open. One is preference shares of Y Limited. Another one is equity shares of Y Limited. So preference shares of Y Limited. In examination hall, no need to open actually these 2 accounts separately. But for understanding purpose, now I am open. Okay. Preference shares of purchasing company and equity shares of purchasing company, no need to open, guys. Okay, concentrate. Now in this ledger also, I'll make the posting to Y Limited. So which is 4 lakhs. Here also to Y Limited, which is 11,20,000. Now PC receipt is over. Now I should need to distribute the purchase consideration along with the existing resource of cash. Am I right? Now concentrate. In order, first what we will make pay realization expenses. We already decided the journal entries for realization expenses. Sir, two entries in the books of selling company. First, that is total two steps. One is we are incurring our own 2,500. Further, the entry is realization account data to cash account. Now you can give posting here realization account data to cash account. In bracket, you can mention realization expenses. How much, guys? 2,500 rupees. In realization to cash, in cash by realization. So how much? 2,500. Next. Another type of realization expenses, how you incurred. First you paid, later on reimbursed by the purchasing company. At the time of making payment, at first instance, the entry is purchasing company account data to cash. That is Y Limited account data to cash. In Y Limited, if you go Y Limited account data to cash, 10,000. For which purpose? Realization expenses purpose. At later time of reimbursement, the entry is cash account data to Y Limited. Then in Y Limited, buy cash. This is at the time of reimbursement. Now the simultaneous posting you can give here in cash account to Y Limited, 10,000, by Y Limited, 10,000. Tell me, guys, both the impact. One is inflow, one is outflow. So this is outflow, this is inflow. So that's why both the sides I recorded. So first, realization expenses over. Next, in the order of making payment, first you should need to make pay to secured creditors. But there is no secured creditor. Outstanding interest on debentures is only one liability exists. That's why you can make payment to the unsecured liabilities. So outstanding interest on debentures, if nothing was said, at which value you are going to make payment, that is at book value. So if you make pay to cash account, 12,000, then outstanding interest on debentures close. Outstanding interest on debentures to cash, then in cash account, by outstanding interest on debentures, that is 12,000. Next, in the order, next you should make payment to preference shareholders. If you observe here, preference share capital is there for 4 lakhs. Sir, for preference shareholders, total how much you are paying? 4,40,000. 40,000 in the form of cash, 4 lakh in the form of 9% preference shares. Now, in preference shareholders, you can pay cash of 40,000. You can pay 9% preference shares of Y Limited. Y Limited, how much? 4 lakhs. So total balance is there under preference shareholders 4 lakhs, but you are paying 4,40,000. That means excess you are paying. So you are getting a loss. Such a loss you should need to make it transfer to realization account. I clearly told at the time of making settlement to various parties, if you derive any profit or loss, it need to transfer to realization account always. So here 40,000 need to transfer to realization. One thing, guys, simultaneous posting we need to give in preference shareholders, it is to cash. In cash, by preference shareholders first. How much? 40,000. Next, in preference shareholders to 9% preference shares of Y Limited, then preference shares of Y Limited by preference shareholders. That is 4 lakhs. With this account is closed actually. Next, in preference shareholders by realization, then in realization to preference shareholders, which is 40,000. All simultaneous posting is over. Then the next step, before making final settlement to equity shareholders, first you need to close realization account. All of you, can you please close the realization account quickly? May I know the profit or loss here? How much profit or how much loss derived here? Please concentrate. So total of the credit side, 3,20,000 plus 5,000 plus 17 lakh 20,000. I got 20 lakh 45,000 here. Here also 20 lakh 45,000. What is the balancing figure under the debit side? Minus 16 lakh 20,000 minus 2,500 minus 40,000. So I got 3,82,500 is the balancing figure, which is profit, guys. It should be need to transfer to equity shareholders account. The profit or loss on realization need to transfer to equity shareholders account. Under realization to equity shareholders, then in equity shareholders account by realization, simultaneous posting 3,82,500. Now all of you concentrate. How much balance is there under equity shareholders account? Can you please check after this? 8 lakhs plus 1,53,000 plus 3,82,500. Total how much? Total how much? 13,35,000. 13,35,500 is the balance there. For such 13,35,500, what you have in your hand? You are having equity shares of Y Limited for 11,20,000 you have. Okay. What is the balancing figure under cash account? Can you please check, all of you, what is the balancing figure under cash account here? Balancing figure under cash account. This total is 2,80,000. So this side is also 2,80,000. The balance you can make it transfer to equity shareholders account. How much is the balance here? 2,500 plus 12,000 plus 40,000. 54,500 minus 2,80,000. So I got 2,25,500, guys. Is it right? 2,25,500. Now in cash by equity shareholders, then equity shareholders to cash. 2,25,500. Remaining to equity shares of Y Limited. So to equity shares of Y Limited, how much? Here it is there, 11,20,000. Now you can make it total, both the things, which is equal to 13,45,500 we are getting here. How the 10,000 excess is there? Any posting is missing? Please concentrate. 10,000 balance difference is coming. Sir, can you please all of you tell me quickly in the chat box why the difference is coming? In the chat box, no one is responding. Please concentrate, guys, quickly. Why that 10,000 difference is there? Sir, cash balance is 2,15,000. Okay, fine. Sir, people are telling cash balance is not 2,25,000, which is 2,15,500. Guys, now in equity shareholders, which is 2,15,500. Fine, guys. Then if you check, here also we are getting 13,35,500. Am I right, guys? Now I corrected it from myself. Now all the accounts closed. If you check, realization account got closed. Cash account also closed. Outstanding interest on debentures closed. Equity shareholders account just now closed. Preference shareholders account over. Preference shares of Y Limited. Equity shares of Y Limited. Once you transferred it to equity shareholders, this account also got closed. Next, Y Limited account is also got closed. Can you please check Y Limited account, which is 17,30,000. This side also I am getting 17,30,000. So Y Limited account closed. So all the books of accounts, that is all the ledgers got closed. This is the accounting treatment in the books of selling company. So almost this is the second problem. The draft problem we've seen through my illustration. This is problem number 1. Now all of you please concentrate. Let me provide accounting treatment in the books of Y Limited. Let me continue my flow, guys. Concentrate. Accounting treatment in the books of which company? Purchasing company. So here the purchasing company is Y Limited. In which method? All of you, can you please tell me? Purchase method. This is important. So here I will pass the journal entries. Here I will pass journal entries. Concentrate. So now in classroom, I don't want to discuss anything about narration because, sir, what is the narration I need to write in the examination based upon the entry in your mind, what thought process is going on, the same thing you can put it as narration. Okay. Now coming to the first entry, all of you, what is the first and foremost entry in case of purchasing company? Business purchase account data to liquidator of selling company. That is business purchase account data at the rate of 17,20,000 at the rate of purchase consideration to liquidator of selling company means Z Limited. Z Limited account, which is 17,20,000. Now all of you please concentrate. Purchasing company is take over all the assets and all the liabilities except cash and outstanding interest. Am I right? Sir, all the assets means I'm taken as a purchasing company, I'm taken over PPEs, intangible assets, inventories, trade receivables. And all the liabilities means other current liability not taken over, trade payable taken over, long-term borrowings taken over, out of the reserves and surplus workman compensation liability is also taken over. But the important point is in the books of purchasing company, I need to incorporate at agreed values, not at book values. Now, is it agreed value is different from book value? Is it agreed value is different from book value? Nowhere mention the agreed values of the assets and liabilities taken over. That's why we can assume that the book at the same book value only we are taking over all the assets as well as liabilities. But for debentures, he clearly told that debentures they are acquiring at the rate of 2,10,000. So the acquisition value of the debentures is only not at book value. For the remaining all assets and all liabilities we are taking over at book values only. Am I right? Oh, sorry. In the last line, actually they told. Sorry, yaar. Please come to the last line. Y Limited valued the land and building and the plant and machinery and the patents. They are taken at agreed value. Sorry, 3 assets they are taken at agreed value. I will consider such values only. Not an issue. Now, first let me put with assets. Land and buildings account data. What is the agreed value? Given 5,50,000. So the next asset is plant and machinery. All of you, you can observe the last sentence. They are given certain agreed values, which is at 6,50,000. Next, out of intangible asset patents account data, which is 20,000. One more intangible asset is there. Out of the intangible assets, patents only they are taken over at agreed value. 50,000 they are taken over at 20,000. Sir, goodwill is there. Goodwill is how much? 2,40,000. Please concentrate. I'll write the goodwill at the end, guys. I don't want to write the goodwill right now. You know why? I will tell you the reason at the end. So just remember, goodwill I need to incorporate, but till now I don't want to incorporate. But till now I didn't incorporate it. Okay. Next, come back. What are all the different assets we have? PPE over, intangible asset except goodwill over. Next, coming to inventories. Inventories account data. Please. Inventory account data. How much? At book value only, which is at 1,50,000. So the next item is trade receivables, which is at 1,80,000. Cash and cash equivalents we are not taken over. Hope all the assets were over. There is no provision on inventories and trade receivables, right? Nothing is given, correct? In the entire problem. There is no provision on debtors as well as inventory. Okay, leave it. Next, come to the liabilities, guys, one by one. Liability, trade payable 1,20,000 to trade payable 1,20,000. Next, long-term borrowings, that is debentures. Which debentures? These are to debentures in Z Limited. At which price we are taken over? In point number 1, they are clearly specifying we are issuing at the rate of 105 per debentures, means the taken over value of the debentures in the books of selling company is not at book value, which is we are taken over at 2 lakhs into 105%, which is 2,10,000. At this price we are taking, because as a purchasing company, you are paying 2,10,000 worth of your debentures. That means the acquisition price of the debentures in the books of selling company is 2,10,000 only. Is there any other liability, guys? Workman compensation liability is there. Don't ignore. So workman compensation liability. How much? 5,000 only, right? 5,000. Now all of you concentrate. Except goodwill, I incorporated all things. So I need to cancel business purchase. I need to cancel business purchase. That is at the rate of PC 17,20,000. Now all of you, please start calculating. Please start doing calculations here. What is the total value of assets minus outside liabilities? That is net asset value. This is except goodwill, guys. This is except goodwill. I know goodwill was not at all incorporated. I know for the time being, you can calculate the NAV without incorporating the goodwill. How much? May I know? 5,50,000 plus 6,50,000 plus 20,000 plus 1,50,000 plus 1,80,000 minus liabilities 1,20,000 minus 2,10,000 minus 5,000. I got 12,15,000 is the NAV. Is it right? Can you please respond, all of you, through chat box? NAV is 12,15,000. PC, business purchase, means purchase consideration, is 17,20,000. The case is PC is greater than NAV. If PC is greater than NAV, then goodwill will occur. Here the goodwill is 17,20,000 minus 12,15,000, which the goodwill is 5,05,000 I got. Goodwill account debtor 5,05,000. You know, sir, I am not incorporating the goodwill given under intangible assets, right? Why? You know, under this 5,05,000, this 2,40,000 is already there. For example, initially, if I incorporate goodwill 2,40,000, again there is a necessity to record the goodwill. That's why, if at all the purchasing company is taken over goodwill of the selling company, then don't incorporate initially. Now, at the time of comparing of PC with NAV, it will be automatically incorporated in such 5,05,000. We are having such 2,40,000 as well. If you are not believe me, for example, please concentrate. If you are not believe me, NAV after incorporation of the goodwill, how much? Before incorporation, 2,15,000. Na? 2,15,000 plus in the NAV, you can consider the goodwill as well. Goodwill of the selling company is 2,40,000. Then at that point of time, NAV is how much? 12,15,000 plus 2,40,000. Total 14,55,000. Now you can compare this 14,55,000 with PC of 17,20,000. Then again, the scenario is PC greater than NAV. Then how much goodwill you are deriving in this case? Goodwill is equal to 17,20,000 minus 14,55,000. You are getting 2,65,000 only. That means if you are already incorporated the goodwill 2,40,000, then you are getting goodwill as 2,65,000. If you add both the things, the total goodwill is only 5,05,000. The same thing I made now. That is the reason, even if goodwill of the selling company is directly given, no need to incorporate. It will be automatically, you can derive it as a balancing figure. That is the conclusion I made through this journal entry. Can you please tell me, is it calculation is correct, right? Arithmetically accurate, correct? Arithmetically accurate, correct? Everything fine. Sir, in question, agreed value of all assets is given. No, guys, in question, agreed value of all assets is not given. If you check here, only few assets are given. For example, in the question, if all assets agreed value is given, you need to consider all the assets and liabilities at agreed value only. But here only some of the assets only agreed value is given. That's why I considered for such assets only. But for the remaining assets, just I incorporated it as it is book values. But in the question, if we ask, you need to incorporate clearly at agreed values, then you can consider such agreed values only. Okay, let me continue the third entry. Now, what you should need to do, you should need to make payment to whom? Liquidator. Liquidator of Z Limited account debtor. Liquidator of Z Limited account debtor. How much is the PC? 17,20,000 you need to pay. Out of this, cash, how much, guys, you need to pay? 2 lakhs. Tell me, guys, here it is there. PC cash 40,000 plus 1,60,000 you need to pay 2 lakhs. Next, preference shares, that is in the form of 9% preference shares. How much you are issuing? 4 lakhs, right? So 9% preference share capital 4 lakhs to 9% preference share capital account 4 lakhs. Next, consider all of you to equity share capital. To equity share capital account. If you check here, the number of equity shares issuing 8,000, but at the rate of 140 face value is 100. That means you need to transfer 100 rupees face value to capital, 40 rupees per share to securities premium. Now 8,000 into 100, 8 lakhs to equity share capital, 8 lakhs to equity share capital, and securities premium to securities premium account, which is 8,000 into 40, which is 3,20,000. Now, if you can make it total of the credit aspect, 2 plus 4, 6, 6 plus 8, 14, 14 plus 3,20,000, 17,20,000, it exactly matched. One more thing, guys, not yet over the entries. Now, debentures of the selling company you need to cancel. You should issue your debentures, right? Now, you can cancel debentures in Z Limited. Debentures in Z Limited account debtor. So the value is 2,10,000. In your company, you are issuing at which percentage? 7% debentures. That is 7% debentures account. The issued debentures face value is 2 lakhs. Premium is 5 rupees. So 7% debentures face value is 2 lakhs to premium on debentures. To premium on debentures, which is 10,000. Am I right? Next. Still one more entry is pending. What is that? Journal entry in the books of purchasing company for the purpose of at the time of reimbursement of cash to the selling company for the purpose of realization expenses. The entry is goodwill account to cash account, 10,000 rupees reimbursed. Earlier we passed entry in selling company. Now we are adjusting in purchasing company. That is goodwill account debtor to cash account, 10,000, being realization expenses reimbursed to selling company. That is the narration. Okay. Anything are there apart from this? Hope all are completed, right? So PC is over. Journal entries in the books, I mean to say closing ledgers in selling company is over. Journal entries in the books of purchasing company is over. This is the full-fledged problem, how in generally you need to do. Sir, due to lack of time, I may not able to discuss much problems, but the problems what I am taking for the discussion, which contains the entire accounting treatment. Now, if you've seen, we check the calculation of PC, we check the closing ledgers in the books of selling company, we completed the journal entries in the books of purchasing company. So, to be frankly speaking, two different things are pending from my side for related to problematic issues. One is preparation of balance sheet in the books of purchasing company after amalgamation. Just now I passed the journal entries, right? After completion of the journal entries, how you can need to present the balance sheet of a purchasing company. We will see such type of problems at the end almost. One more thing, accounting treatment in the books of purchasing company, if the method of amalgamation is pooling of interest method. I mean to say, if the amalgamation type is amalgamation in the nature of merger, then what is the accounting treatment you need to adopt in the books of purchasing company? I need to explain. Such two things are only pending. Otherwise, almost all things and all types are covered related to the theory. Okay, now come back. Let me proceed with the further problems, guys. Certain problems are there which are highly related to calculation of PC. I can correlate it to accounting standard 14. There may be a chance of asking such questions for 5 marks in the examination. So if you check problem number 2, at the end they ask you are required to calculate the purchase consideration. Now all of you, I will read the problem. We will do such problem in my OneNote. Sundry assets is given. So first start here. S Limited is absorbed by P Limited. P Limited means purchasing company. S Limited means selling company. The draft balance sheet of selling company is given. Assets information is there. 7% preference share capital, equity share capital, reserves, debentures, trade payables. Come below. P Limited has agreed to issue 9% preference shares of 100 each in the ratio of 3 shares of P Limited for 4 preference shares in S Limited. For every 4 preference shares, purchasing company is ready to issue 3 shares. In selling company, how many number of preference shares are there? 2000 preference shares are there. Then for 2000 preference shares, how many preference shares need to be issued? 2000 into cross multiplication, guys. 2000 into 3 by 4. Am I right? Each preference share is issued at how much? 100 rupees. This is nothing but amount payable to preference shareholders. Next, coming to point number 2. To issue to the debenture holders in S Limited, as per accounting standard 14, amount payable to the debenture holders of the selling company is not form part of PC. No need to read at all. No need to read at all. Just I am calculating the PC. Amount payable to the debenture holders of the selling company is not form part of the PC. Only amount payable to the shareholders of the selling company is alone treated as PC. No need to read point number 2. Come to point number 3. To pay 20 rupees per share in cash and to issue 6 equity shares of 100 each, the market value is 125 in lieu of every 5 shares held in S Limited. I mean, they already discussed about preference shareholders. Now this discussion is related to equity shareholders. For equity shareholders, purchasing company paying in 2 forms. One is cash. Cash is how much? 20 rupees per share in cash. How many number of equity shares are there? 5000. 5000 into 20 in the form of cash. In the form of equity shares, I am issuing 6 equity shares for every 5 shares held. For every 5 shares held, I am going to issue 6 equity shares. How many number of equity shares are there? 5000 equity shares are there. For 5000 equity shares, how many number of shares need to be issued? I need to issue 6000 equity shares. You can make the cross multiplication, then you will get 6000 equity shares. Am I right? Tell me, guys. 6000 equity shares into each equity share worth how much? 125 rupees. This is amount payable to equity shareholders in the form of equity shares, in the form of cash. Now, if I make it the total, then I will get purchase consideration under which method? Net payments method. Tell me, guys, I can able to ascertain amount payable to preference shareholders as well as amount payable to equity shareholders. Then the method of PC is net payments method. Coming to my OneNote. So let us quickly complete this problem. Only calculation part is pending. Remaining all is completed already in material itself. How you should need to present? For that purpose only I am doing the problem in OneNote, nothing else. Tell me, guys, calculation of PC. In which method? In bracket, net payments method. Particulars, amount rupees. You can start with amount payable to preference shareholders. That is to preference shareholders, how much you are paying. Can you please tell me, guys, in the ratio of 3 shares of P Limited for every 4 preference shares in S Limited, right? That is simply 3 preference shares issued for every 4 preference shares in selling company. Then the calculation is 2000 into 4 by 3 into 100. How much? Is it 4 by 3 or 3 by 4? Sorry, it's 3 by 4, not 4 by 3. 3 by 4. So how much, guys? 2000 into 3 into 100 divided by 4. So which is 1,50,000. Amount is 1,50,000. Next, coming here to equity shareholders. First, in the form of cash, how much? In the form of cash, 5,000 into 20. So which is 1 lakh. In the form of equity shares, how much? Equity shares, how they are issuing? For every 5 shares held in S Limited, 6 equity shares are issued. That is 5 equity shares. Sorry, we are issuing 6 equity shares issued for every 5 equity shares in selling company. The calculation part is 5,000 into 6 by 5. 5,000 into 6 by 5. Each share is issued at 125 rupees. That is 6,000 into 125. How much you will get? 7,50,000. Now what is the total amount of PC? 7,50,000 plus 1 lakh, 8,50,000, 8,50,000 plus 1,50,000, 10 lakhs. This is the total amount of PC. Maybe there is a scope of asking such type of problems for 5 marks, guys. Problem number 2 is over. Okay. So hope you are all are following my speed, guys. Can I continue? Is it over? Can I see problem number 3? All of you, quickly, guys. Yes, you are in same pace with me. Hope you are in same phase. Let me continue with problem number 3, guys. So the break will come in and around approximately 40 minutes. We can resolve 2 to 3 more problems. Okay, if there are small problems exist. So problem number 3 is a special problem which is also related to calculation of PC, but the method of PC is quite different. Please consider here. Neil Limited and Gagan Limited amalgamated to form a new company. That means both are selling companies. This is also a selling company. This is also a selling company, which is a pure amalgamation. A new company is incorporated to take over 2 existing companies, which is a pure amalgamation on 1/4/2015. First, let me check the final requirement. I will read the remaining all. You are required to compute purchase consideration, equity and preference shares issued to Neil Limited and Gagan Limited. Simply they're asking PC and a number of equity shares issued to Neil and a number of equity shares issued to Gagan. As well as in the same way, number of preference shares issued to Neil as well as Gagan, just simply they are asking. Okay, let it be. Next. Now let me read the content. So 2 companies, Neil, Gagan, assets given, plant and machinery. Next, building, current assets. Very few assets are there. In liabilities, capital is given, current liabilities is also given. Following are the additional information. The authorized capital of the new company will be 25 lakhs divided into 1 lakh equity shares of rupees 25 each. Indirectly, he is giving an hint that in the new company, whenever such new company is going to issue in the form of equity shares, always the face value is 25 rupees. So through point number 1, it is given that, so simply the new company is going to issue each and every equity share at the rate of 25 rupees each, which is the face value as well. Liabilities of Neil Limited includes 50,000 due to Gagan Limited. Sir, for calculation of PC, this point is irrelevant. Only the relevant points only I want to read. Sir, intercompany owings, is it relevant for the purpose of calculation of PC? No. Which is intercompany owings, guys? Liabilities of Neil Limited includes 50,000 due to Gagan Limited. So that means Neil Limited should pay something to the Gagan Limited, which is an intercompany owings, not required for me. Sir, made a profit of 20% on sale, which is required for the purpose of calculation of stock reserve. So such all things are irrelevant for calculation of PC. Simply ignore. Only the relevant items let me read. Neil Limited had purchased goods costing 10,000 from Gagan Limited. All these goods are included in the current assets of Neil Limited. This is for intercompany owings. This is for creation of stock reserve. This is also irrelevant. Tell me, guys, sir, if appropriate place, I will discuss such adjustment in other problems. But for this problem, this is irrelevant. So that's why first I read what I required, purchase consideration. Okay, next. Coming to point number 4 and point number 5. The relevant information is there in point number 4 and point number 5. The assets of Neil Limited and Gagan Limited are to be revalued as under plant and machinery revalued, building also revalued in both the companies. Now coming to point number 5, the purchase consideration is to be discharged as under issue 24,000 equity shares of rupees 25 each, fully paid up in proportion of their profitability in the preceding 2 years. Purchasing company is going to issue equity shares to Neil Limited and Gagan Limited, total 24,000 equity shares. Such 24,000 equity shares is going to be issued in their profitability ratio of the preceding 2 years. What is the profitability for their preceding 2 years? Just it is given that 4,75,000, 5,25,000. That means you can issue 24,000. You can issue 24,000 equity shares here in this ratio. 475 divided by 1000. Here 24,000 into 525 divided by 1000. Then you can easily know how many number of equity shares issued to Neil Limited, how many number of equity shares issued to Gagan Limited. What is the worth of equity share multiplied by 25? That means how much worth of equity shares going to be issued to the selling company clearly given in the problem. You can able to ascertain amount payable to equity shareholders of the selling company. Next, coming to point number D. Concentrate guys, all of you. Issue 12% preference shares of ₹10 each, fully paid up at par, to provide income equivalent to 8% return on net assets in the business as on 31st March 2015. After revaluation of assets of Neil Limited and Gagan Limited respectively. Sir, I can't understand anything. Only one thing I understood. This is amount payable to preference shareholders of the selling company. Do you agree? This is related to amount payable to the preference shareholders of the selling company, because amount payable to the equity shareholders of the selling company already over in through point number B and point number C. Now they are discussing only in point number D, amount payable to preference shareholders of the selling company. Now, purchasing company is going to issue preference shares to the selling companies. Here two selling companies are there. Here two selling companies are there. Am I right? Now, issue 12% preference shares. So now the issued preference shares are 12% preference shares, that I know. And each preference share face value is 10 rupees. I know that as well. 10 rupees. How many number of preference shares I am going to issue? I don't know. These are number of preference shares. I don't know. Each fully paid up at par to provide income equivalent to 8% return on net assets. Income equivalent, which equal to 8% return on net assets. Now, income means what is the income on preference shares? Dividend only. Now, the dividend on the preference shares is nothing but he is simply telling that, sir, how many number of preference shares you need to issue, you know? Dividend on issued preference shares should be equal to 8% return on net assets. Such many number of preference shares you need to be issued. I need to issue such a number of preference shares that the dividend declared on such preference shares should be equal to 8% return on net assets. That means number of preference shares is question mark here. Am I right? Now consider all of you. We can calculate the net assets very easily. Net assets is nothing but net asset value. Sir, the net assets of Neil Limited and Gagan Limited, how we should need to calculate? After revaluation of assets and liabilities. If you check here, plant and machinery revalued figure, building is also revalued figure, but current assets is at book value, current liabilities is at book value, then you can get easily net asset value. That means we can easily calculate net assets. If you apply 8% on net assets, you will get the right-handed factor. Then you can calculate the number of preference shares easily. Once you will get the number of preference shares to be issued to Neil Limited and Gagan Limited, you can also know the worth of preference shares to be issued. Why? Because the worth of preference share each one is 10 rupees. Then you can easily calculate PC. That means you can, once the calculation of PC is over, then you can automatically get number of equity and preference shares also to be issued to each and every selling company specifically. Now let me check the entire content in my OneNote. Please all of you concentrate. So the discussion is not yet over. The basic discussion just now I made through material. Now we are doing the remaining things to my OneNote. So the problem is problem number 3. Sir, now you may ask, sir, what is the method of PC here, sir? It's very confusing. In which method we can adopt, sir? Which is net payments only, guys. Can you able to ascertain amount payable to equity shareholders? Yes. Can you able to amount payable to preference shareholders? Yes. After making some calculation, I can assess, right? So that's why the method of PC is still, the method of PC is a net payments method only. Net payments method only. Now, in the first instance, to equity shareholders, how much you are paying? Here 2 companies are there. One is Neil, another one is Gagan. To equity shareholders, it is clearly given that in such ratio, right? 24,000 equity shares we are issuing. 24,000 equity shares in 475:525 ratio at the rate of 25 rupees each. Now 24,000 into, in bracket, 24,000 into 475 divided by 1 lakh, then you will get number of equity shares. If you can multiply with 25, you will get the worth. Here 24,000 equity shares into 525 here. 525 divided by, it's not 1 lakh, 1,000. You can put it as 1,000, guys. Sorry. 1,000 into 25. Now, can you please tell me the amounts here? 24,000 into 475. Here I got 2,85,000. Am I right? Here I got 2,85,000. Next, here $3,15,000. This is the worth of equity shares to be paid to the specific selling companies. Next, coming to preference shareholders, guys. To preference shareholders. Now, all of you, if I want to calculate amount payable to the preference shareholders, first I should need to calculate net assets. Now, let me go to the working note here. In the working note, I need to calculate net assets. Just a second. Yeah, working note, calculation of net assets. In both the books, I need to calculate. Please consider the revalued figures, guys. Plant and machinery, 5,25,000, 6,75,000 in Neil and Gagan. Next, building, 7,75,000. Next, 6,48,000. Current assets are also there, which are taken at book value only, guys. These are only 2 are at agreed values. Okay. So current assets, if you consider 1,63,500, and the other one is 1,58,600. Less current liabilities. Current liabilities also you can consider the book value. That is only one and only outside liabilities, 6,23,500 and 5,57,600. Now, can you please tell me the net assets worth? All of you. Please participate through the chat box. You should need to do along with me. Then only you are in the same pace. Is it right, guys? My calculations are right. So the net assets for Neil Limited is 8,40,000 and the net assets for Gagan Limited is 9,24,000. Now come back here, all of you. Come back here. Oh, so much of gap given by me now. Okay. Now to preference shareholders, I don't know how many number of preference shares need to be issued, but I made one equation. What is that? I need to issue such a number of preference shares. The dividend on such preference shares need to be equal to 8% return on net assets. Am I right? So first, let me calculate 8% return on net assets, guys. 8% return on net assets. First, let me calculate. So 8% return on net assets, how much? 8,40,000 into 8%. 8,40,000 into 8%. How much? Which is 67,200 here. Here 9,24,000 into 8%. Am I right? Which is 9,24 only, right? Correct. Into 8%. So I got here 73,920. Now concentrate, all of you. Now if I consider number of equity shares into the face value as X, let us assume this is X. Number of equity shares into face value is X. Then 12% into X is equal to 8% of the net assets. Now X is equal to, that is the worth of preference shares need to be issued. Therefore, amount of preference shares to be issued, amount of, let us assume amount of preference shares to be issued is X. In bracket I am mentioning, let us assume which is an X. X is equal to, formula guys, X is equal to 8% into net assets divided by 12%. You know already 8% into net assets is already there, which is 67,200. So 67,200 divided by 12% here. Here also 73,920 divided by 12%. Then I can easily get amount of preference shares to be issued. How much? Here it is 5,60,000. 73,920 divided by 12%. Here it is 6,16,000. Now you can calculate the total amount of PC. So only the highlighted figures only you can consider, guys. This is amount payable to equity shareholders. This is amount payable to preference shareholders. Only highlighted things you can consider. Then you will get the purchase consideration. Here 2,85,000 plus 5,60,000. 8,45,000. Here 3,15,000 plus 6,16,000. Here it is 9,31,000. This is the amount of purchase consideration. Okay. Now concentrate. What is the specialty of this problem? I will tell you. The method of PC is net payments. I too agree. The method of PC is net payments. I too agree. But out of such net payments method, to know amount payable to preference shareholders, you applied a net asset value method. Part of the thing you applied the net asset value method for the purpose of knowing amount payable to the preference shareholders. Part of the thing you consider net asset value method. That means which is a combination of more than one method. A single method, the net payments method, also contains another method which is net payments method. Such type of problems are known as combinative methods. Sir, just now here I work out only point number 2. Now still point number 1 is pending. What is point number 1? They asked in the problem equity and preference shares issued to Neil Limited and Gagal Limited. You can easily calculate number of equity shares to be issued. Sir, each equity share is issued at 25 rupees na? Then 2,85,000 divided by 25 rupees. That is 11,400 shares. 11,400 shares. How we are getting? 2,85,000 divided by 25 rupees. Now here 3,15,000 divided by 25. How many number of shares? I get 12,600 shares here. This is number of equity shares to be issued. Then coming here, number of preference shares to be issued. Number of preference shares to be issued. Sir, this is the total amount of preference shares is 5,60,000. That is 5,60,000 divided by 10 rupees per share. Now I am issuing, which are 56,000 preference shares. Here it is 6,16,000 divided by 10 rupees, which is 61,600 shares. So question number 1 is also over. Question number 2 is also over. Under the main question 3. Hope you understand everything. If you have any doubt, please let me know quickly. Before proceeding with the next problem, please let me know, guys. What they are selling? Sir, instead of 3,15,000, it is 3,45,000 is Gagan Limited. Any calculation issue, guys? Sir, is it not the 3,15,000? It is 3,45,000. In case of Gagan, can you please check? Tell me. It's 3,15,000 only, yaar. Please check it. Correct only. Okay. So if you have doubt, you can cross verify the answer with printed solution always. But I don't want to consider the arithmetical errors at this point of time because I am in very much higher pace. I know. I'll verify for you. Just a moment. Which is problem number 3, right? Yeah. So 8,40,000 and 9,24,000 is the net asset value method, which is 3,15,000 only, guys. Please consider. Maybe the error is there from your side, my dear friend. Please check it. Okay, fine. Right. Next, let us proceed with the last problem for the PC, guys, which is I can put it as last problem for the PC. So let me read the content. First, let us check the last requirement, calculate the purchase consideration. Again, this problem is the final problem for the purpose of calculation of PC. Come here. Let us consider the balance sheet of X Limited as at 31st March 2011. This is the balance sheet of X Limited. Share capital given. In share capital, 7,50,000 equity shares are there, which are at 75 lakhs. 25,000, 14% preference shares of 100 each, which is 25 lakhs. So total 100 lakhs or 1 CR. Total 100 lakhs. Okay, he's given the total amount is 100 lakhs. Next, coming here, reserves and surplus is 12,50,000. If you consider rupees in thousand here, rupees in thousands, that is missing. Okay. Under reserves and surplus, general reserve is only there, which is for 2,50,000. And under long-term borrowings, 14% debentures are there. Next, current liabilities, trade payables is there. Under non-current assets, property, plant and equipment exist. Under note number 4, if you see PPE, land and building is there, plant and machinery is there, furniture is there. Next item, non-current investments. If you coming to note number 5, investment at cost is given, which are at 5 lakhs. Which are at 5 lakhs. So just I am reading the balance sheet information. That's why I'm quickly read. Okay, nothing is there. Next, current assets, inventory, trade receivables, cash and cash equivalents. Now let us come to the further information. Y Limited takes over the X Limited. Y Limited is a purchasing company. X Limited is a selling company. That is the reason why he is providing the balance sheet of X Limited. So selling company information is given. Next, debenture holders of X Limited are discharged by irrelevant. Amount payable to the debenture holders of the selling company is completely irrelevant in calculation of purchase consideration. Okay, no need to read point number B. Coming to point number C and D. 14% preference shareholders of X Limited are discharged at a premium of 20% by issuing necessary number of 15% preference shares of Y Limited. Now, first let me know how many number of preference shares are there in the selling company. 25,000 preference shares are there. Now, the 25,000 preference shares are discharged with the premium means at 120% because face value is 100 means at premium means 120%. That is 25,000 into 120% means amount payable to preference shareholders. 25,000 into 100 into 120%. Sorry. So how much, guys? The worth is how much? 25,000 into 100 into 120 percentage. It's 30 lakhs, right? Which is equal to 30 lakhs. Next, come to point number D, all of you. Intrinsic value per share of X Limited is rupees 20. And that of Y Limited is 30. Intrinsic value per share in selling company is 20 and purchasing company is at 30. Y Limited will issue equity shares to satisfy the equity shareholders of X Limited. Now consider all of you. Now what is the amount payable to equity shareholders of selling company? How much amount? How much amount need to make to pay to satisfy the equity shareholders of the selling company in case of intrinsic value method? Sir, in case of intrinsic value method, the PC formula is number of equity shares in selling company into intrinsic value per share in selling company. First, how many number of equity shares are there in the selling company? 7,50,000 equity shares are there. 7,50,000 into intrinsic value per share in the selling company is how much? 20 rupees. Then what is the worth here? 7,50,000 into 20 rupees. That is 150 lakhs worth I need to pay. 150 lakhs worth I need to pay to the equity shareholders. But still not as over. Please concentrate. Will issue equity share to satisfy the equity shareholders of X Limited on the basis of intrinsic value. However, the entry should be made at par value only. So the PC, this is at the rate of issue price, guys. 150 lakhs is at the rate of issue price. But if you want to know how much is the PC at par value, first you need to calculate number of equity shares issued as PC. To know the number of equity shares issued as PC, you need to divide the total amount of PC divided by issue price. Here issue price is nothing but intrinsic value per share in the purchasing company. That is 150 lakhs divided by 30 is equal to 5 lakh equity shares you are going to issue. Sir, if the number of equity shares issue is 5 lakhs and each equity share face value is 10 rupees, then PC is recorded at par value is 5 lakhs into 10 rupees, which is equal to 50 lakhs. Therefore, amount payable to equity shareholders, if I recorded at par value, which is 50 lakhs, amount payable to preference shareholders is at 30 lakhs, then 30 lakhs plus 50 lakhs, the total amount of PC is 80 lakhs. Sir, what is the method of PC in this problem, sir? The method of PC is net payments method, but in such net payments method, again, to calculate amount payable to equity shareholders, I am applying the intrinsic value method, which is again a combination problem like the previous problem. In the previous problem, the method of PC is net payments method, but to know the amount payable to equity shareholders, I applied some part under NAV. But here in this problem, also the method of PC is net payments method. Now to know the amount payable to equity shareholders, I applied the method intrinsic value method. Such type of problems are known as combination methods. More than one method is applicable. For overall net payments, to know amount payable to equity shareholders, I applied intrinsic value method. Let me explain the things one more time in my OneNote clearly. Please consider all of you. No issue if you have any doubt. Such doubts are going to resolve through my OneNote. Just hold for a second. Yeah, problem number is 4, right? Which is problem number 4. Now, PC is under net payments method. Now, amount payable to preference shareholders, how much? Amount payable to preference shareholders, how much, guys? Here, check. Discharged at a premium of 20%, we have 25,000 preference shares, right? Now, 14% preference shares issued at the rate of 100 rupees each by discharging with the premium. By discharging with the premium. If you check here, our company shares are we are going to issue at 100 only, but discharging only happening at 20%. Now the existing number of preference shares are 25,000. Now the existing number of preference shares are 25,000, which have the face value of 100 rupees, but I'm discharging at 120 rupees each. That is 20% premium. The amount is 30 lakhs. Am I right? Next, coming to equity shareholders. Now, in case of equity shareholders, what he is given, he is simply telling that first entry should be made at par value only. In bracket, you can clearly write that, okay, recorded at par. First, if it is need to recorded at par, first you should need to calculate number of shares issued as PC. All of you please concentrate. Then PC is recorded at par. Then how you need to calculate number of equity shares issued by X Limited into face value is the formula of a PC. Now, how to get the number of equity shares issued by X Limited? That is total intrinsic value of the selling company. What is the total intrinsic value of the selling company? Which is 20 rupees per share. How many number of equity shares are there in the selling company? Concentrate. How many number of equity shares are there? 7,50,000. So the total intrinsic value of the selling company is 7,50,000 into 20 rupees. This much of amount I need to pay. But I am issuing such amount at the rate of intrinsic value of the purchasing company. So intrinsic value of the purchasing company is how much, guys? Here given. That is issue price of the purchasing company. 30 rupees. Sir, still if you have any doubt, you can check the formula what I told, which is nothing but number of equity shares issued as PC, which is nothing but number of equity shares issued as PC. If you can multiply with the face value, then you will get PC is recorded at par. I will open the formula. We already discussed such formula under intrinsic value method. 1 second. Yeah. So if PC is recorded at par value, if PC is recorded at issue price, then the entry is number of shares issued as PC into issue price. If the same PC is recorded at par value, then number of shares issued as PC into face value per share. Then how to calculate number of shares issued as PC in case of intrinsic value method? Number of shares issued as PC is equal to number of equity shares in selling company into intrinsic value per share in the selling company, which is 7,50,000 into 20 rupees divided by intrinsic value per share in the purchasing company, which is 30 rupees. The same thing I made right now here, if you observe. Am I right? Now, how much worth we will get, guys, here? That is 7,50,000 into 20 divided by 30 into 10 rupees. So we are getting 50 lakhs, right? So the amount is 50 lakhs. So total 30 lakhs plus 50 lakhs. The total amount of PC is 80 lakhs. So which is amount of purchase consideration. Now again, one more time repeating, even though the PC is under net payments method, while payment made to equity shareholders, we are applying the intrinsic value method. That's why we can call it as more than one method applied. The speciality of the issue is here, we are recording the PC at par. Whenever they asked to record the PC at par, first you need to calculate number of shares issued as PC. So the number of equity shares issued by X Limited into face value per share. How you will get number of equity shares issued as PC? The total amount of PC, which is intrinsic value per share in selling company into number of equity shares in the selling company divided by intrinsic value per share in the purchasing company. If you can multiply with face value, then you will get the purchase consideration recorded at par. For example, if you not used the word PC is not recorded at par, then in generally we will record the formula is 7,50,000 into 20 over. Intrinsic value of the selling company is 7,50,000 into 20. Then we will get almost 150 lakhs. I think so. That itself is the amount payable to equity shareholders. But due to specifically mentioning that he wants to record the PC at face value, so that is the reason why I need to apply this much of formula. Do you understand my view, guys? Okay. Come back. Let me check. Yes, sir, it's clear. Total 80 lakhs. Yes. So still we have 10 minutes time, guys. Please all of you concentrate along with me. Let me take problem number 5 for the discussion. Within 10 minutes, we will get the break. The following draft balance sheet are given as on 31st March 2014. What he required? Final first, let me check the requirement. Then I will read the content accordingly. Make the closing ledger in the books of Better Limited. Closing ledger means maybe Better Limited is a selling company. And opening journal entries in the books of Best Limited, maybe which is a purchasing company. And after that, you need to prepare the balance sheet at 1st April 2014 after takeover. Okay. So now from this problem, we are going to see how to draft the balance sheet as well. Okay. Please concentrate, all of you. Or you can do one thing, guys. This problem is a little bit bigger. You can do one thing. At this stage, you can take the break, guys. Yes, actually, I thought of giving the break by 8:50, but you can take the break at 8:40. Please, all of you assemble exactly by 8:50. Otherwise, in between the break, my flow will disturb. You can take the break, all of you. Please come back exactly at 8:50, guys. Okay. Yes, guys. Please all of you come to problem number 5, right? So totally we are doing three things. One is closing ledgers in the books of selling company and journal entries in the books of purchasing company. And finally, after passing the journal entries, we should need to prepare the balance sheet of the purchasing company after completion of amalgamation. The only special point is preparation of the balance sheet after amalgamation. Remaining all we already seen. Now come here. So two companies balance sheets are given. First, if you check the asset side, fixed assets, investments, current assets are given. Coming to the liabilities, share capital is there, reserves and surplus given, other liabilities are also given. Right now, fixed assets are replaced with PPE. You know, might be this is the old problem. So that's why they are given like this. Next, the following further information is given. Better Limited issued bonus shares on 1st April 2014 in the ratio of 1 share for every 2 held out of reserves and surplus. So, hope you already know the concept of bonus shares. If at all not known, not required any further provisions as well. In the point, it is clearly given that bonus shares are issued out of reserves and surplus. Now, due to issue of bonus shares, what will happen? Reserves and surplus got decreased and the share capital got increased. That's it. So the entries reserves and surplus accounted are to equity share capital account. Now, for how many number of bonus shares we issued for existing shares? If you check, the number of existing shares are in Better Limited, rupees 10 lakhs means divided by 100 means that is 10,000 equity shares, right? Existing 10,000 equity shares into 100, then only it is equal to 10 lakhs. That means bonus ratio 1:1. In the ratio of 1 share, sorry, not 1:1. Bonus ratio is 1 share for every 2 held. So we are issuing for every 2 shares 1 share. Then for 10,000 equity shares, how many number of bonus shares we can go to issue? 5,000 equity shares we may issue. Am I right? Then, sir, each equity share worth is 100 rupees. Then 5,000 into 100 means 5 lakhs. That means I need to pass this entry, reserves and surplus 5 lakhs to equity share capital 5 lakhs. Then automatically what happens in Better Limited? Equity share capital 5 lakhs increased, reserves and surplus 5 lakhs decreased. That is the issue happened. Okay, next. It was agreed that Best Limited will take over. It is a purchasing company. Better Limited is a selling company. It was agreed that Best Limited will take over the business of Better Limited. On the basis of the latest balance sheet, the consideration taking the form of allotment of shares in Best Limited. It is clearly given that Best Limited is taken over Better Limited after happening of issue of bonus shares. That means the Better Limited balance sheet is in this way. Share capital 15 lakhs, reserves and surplus 3 lakhs, other liabilities 2 lakhs. There is no change in the total assets. The later balance sheet is taken over by the Best Limited through allotment of shares in Best Limited. That means purchase consideration is in the form of equity shares. The value of shares in Best Limited was considered to be 150. And the shares in Better Limited were valued at 100 after the issue of bonus shares. Even though he is not mentioning these are intrinsic values, you may assume that these are intrinsic values only. Sir, one person asked in chat box, the doubt is, sir, what is the meaning of intrinsic value? I told at that point of time, intrinsic value is nothing but net asset value per share. There is no difference between intrinsic value per share and net asset value per share. The total net asset value, if you divide it with the number of equity shares, then automatically you will get intrinsic value per share. Okay. Now, the value per share in the purchasing company is 150 and the value per equity share in the selling company is 100. Now, what is the amount of PC? You know, purchase consideration is equal to number of equity shares in the selling company. How many number of equity shares are there after issue of bonus shares? Total 15,000 equity shares are there. First 10,000. Bonus shares we issued 5,000, total 15,000. into intrinsic value per share in the selling company. How much is the intrinsic value per share? 100. So 15,000 into 100, 15 lakhs is the amount of PC. But if they ask how many number of shares you can issue as a PC, sir? Sir, number of shares are 15 lakhs divided by 150. So how many number of shares you are going to issue? 10,000 equity shares you are going to issue at the rate of 150 each. Out of that, 100 rupees is the face value, 50 rupees is the premium. Okay. Next, coming to point number D, liabilities of Better Limited include 1 lakh due to Best Limited. If you check here, liabilities of liabilities of Better Limited. Sir, liabilities means out of the other current liabilities, 2 lakhs is there now. Out of such 2 lakhs, 1 lakh is due, is related to the Best Limited. Maybe this 1 lakh is there under other liabilities of Better Limited, as well as the same 1 lakh is there under current assets of Best Limited, which is intercompany owings. Maybe selling company purchased goods from the purchasing company before the amalgamation. So to that extent, 1 lakh is there under creditors of Better Limited. The same 1 lakh worth is there under debtors of the Best Limited. Okay. What you should need to do during the process of amalgamation, you should eliminate such intercompany owings by passing the entry current liabilities account to current assets account to the extent of 1 lakh. Next, for purchase from it on which Best Limited made a profit of 25% of the cost. So whenever Best Limited sold goods to Better Limited, it add 25% profit to the cost. If the cost is 100, profit is 25, then selling price is 125. The goods of 50,000 out of the said purchases remained in the stock on the date of the above balance sheet. In the current assets of Better Limited, where is the current assets of Better Limited? Here Better Limited is there. Under the current assets, 5 lakhs, 50,000 worth of stock is there. Such stock is evolved due to making purchase of goods from the Best Limited. Now, this 50,000 is representing at 125 rupees. Am I right? This 50,000 is representing at 125 rupees. Now, out of that 25 rupees is the unrealized profit. Now, for 125 rupees, if the amount is 50,000, then 25 rupees profit, unrealized profit is how much? 25 divided by 125 into 50,000. That is 10,000 is the unrealized profit. For such 10,000, you need to create the stock reserve entry, goodwill or capital reserve account data to stock reserve account 10,000 amount. Okay. Next, first I should need to adopt the closing ledgers in Better Limited. Please all of you concentrate. I'll do this problem very quickly. We are not having that much of time. Please concentrate. Follow the flow along with me. So because this is not the first problem, we already done some problems. First, accounting treatment in the books of selling company. So here selling company is Better Limited, right? In the books of Better Limited, 5-step approach, dismantling of balance sheet. You need to start with realization account. Open the realization. Sir, if nothing is mentioned, all assets are taken over, all liabilities are taken over by purchasing company. So in this problem, all assets and all liabilities are taken over by purchasing company. And one more account you need to open, which is Best Limited, which is purchasing company account. You can open this account as well. Okay. So next, equity shareholders account also you need to open. There are no preference shareholders. If you check, only equity shares are there. You can open that. Here I'm opening the equity shareholders account. Then you can start closing the ledgers. Step number 1, dismantling of balance sheet. Please all of you consider, now the balance sheet will become Better Limited. Share capital is 15 lakhs. Reserves and surplus is 3 lakhs. After inclusive of 5 lakhs, it becomes 15 lakhs. After decrease of 5 lakhs from reserves and surplus, it becomes 3 lakhs. Please remember such point, all of you. Now in dismantling of balance sheet, all the assets and liabilities taken over by the purchasing company should be closed and transferred to realization account at book values. To fixed assets account. At book value, how much? For Better Limited, 15 lakhs. Next item, investments not there. Current assets, how much? 5 lakhs. To current assets, 5 lakhs. Assets over. Coming to liabilities. By current liabilities, by other liabilities. By other liabilities, how much? 2 lakhs. Only in Better Limited you need to concentrate. Next, assets liabilities transfer to realization. Share capital and reserves and surplus you should need to transfer to equity shareholders account. So in equity shareholders, by equity share capital. Equity share capital is 15 lakhs, guys, which is not 10 lakhs. After issue of bonus shares, it will become 15 lakhs, right? Next, reserves and surplus, 8 lakhs minus 5 lakhs, which is 3 lakhs. By reserves and surplus, which is 3 lakhs. So now entire disbanding of balance sheet is over. Then step number 2, PC due. Step number 2, PC due. You need to calculate the purchase consideration. Actually, I am providing the working note here itself. Calculation of PC. Calculation of PC. Which method you know? Intrinsic value method. Intrinsic value method. Even though he not mentioned specifically, the method is intrinsic value method only. So how to calculate PC in case of intrinsic value method? Number of equity shares in number of equity shares in selling company into intrinsic value per share in selling company. Number of equity shares in selling company, how much? How many? 15,000 equity shares are there. Intrinsic value per equity share in the selling company is given how much? After issue of bonus share, 100 rupees. So the purchase consideration is equal to 15 lakhs. You can write here itself number of shares issued as PC. Therefore, number of shares issued as PC is equal to 15 lakhs divided by intrinsic value per share in the purchasing company. 150 is equal to 10,000 equity shares. I mean to say, out of this 15 lakhs, 10 lakhs will go to equity share capital. In purchasing company, I am telling 5 lakhs will go to securities premium. Okay. Just for reference, I am giving. No need to give such references actually. Just for reference, I am giving. Now, step number 2, PC due. The entry is purchasing company account to realization by Best Limited account in working note number 1, which is 15 lakhs. Now in realization by Best Limited, in Best Limited to realization, which is 15 lakhs. Am I right? Next, step number 3, PC receipt. What you are receiving? Equity shares of Best Limited. Just assume all of you, I don't want to open again one more account. Equity shares of Best Limited account that are to Best Limited account. Then in Best Limited, by equity shares of Best Limited we are getting for the worth of 15 lakhs. With this account got closed. Now there is separate account of equity shares of Best Limited is there in your books of accounts, but I don't want to open. I already told you, with me, equity shares of Best Limited is there already. Next, once the PC received, you need to distribute in the particular order. Sir, all the assets taken over, all the liabilities taken over. That's why there are no assets or liabilities there in my books of accounts. Now in the order means there is no liability, then you can directly make distribution to the equity shareholders here. But before making distribution to equity shareholders, you can find the realization profit or loss. Here it is 20 lakhs. Here it is 20 lakhs. So the profit is how much? 3 lakhs. You can make it transfer to equity shareholders account, which is loss, guys, not profit, which is loss. So in realization by equity shareholders, in equity shareholders to realization, which is 3 lakhs. Now, to pay amount to equity shareholders, what you have in your hand? Equity shares of Better Limited. Please, you can make it pay equity shares of Better Limited. How much you need to pay? 15 lakhs. You can check the balance in equity shareholder is 15 plus 3, 18, 18 minus 3, 15 lakhs. If you issue this 15 lakhs, equity shareholders account got closed. all accounts are closed in the books of Better Limited. Such a simple problem, guys. Okay. Now, journal entries in the books of which company, guys? Best Limited. What is the first entry? Business purchase entry. Business purchase account debtor. Liquidator of Better Limited account at the rate of PC. PC is how much? 15 lakhs. Sir, if nothing is mentioned, all assets and all liabilities we are taken over at book values only. If you consider all the book values one by one, fixed assets is at 15 lakhs. Fixed assets account debtor, which is at 15 lakhs. Next, investment not there. Current assets account debtor, 5 lakhs. To other liabilities, how much, guys? Other liabilities, 20 lakhs. Am I right? Now you can cancel the business purchase as well, which is nothing but PC. 15 lakhs. Now consider all of you. What is the total amount of NAV? 15 plus 5, 20. Sorry here. Other liability is not 20 lakhs. It's 2 lakhs. Sorry. It's 2 lakhs. Other liabilities is 2 lakhs, right? Fine. Concentrate. Sir, if you consider the net asset value of the business, 15 plus 5, 20, 20 minus 2, 18 lakhs. So, PC is 15 lakhs and NAV is 18 lakhs. Am I right? So, PC is less than NAV. If PC is less than NAV, then capital reserve will come to the extent of 3 lakhs. So, you can record here 2 capital reserve. So, the balance is 3 lakhs. Coming to the third entry, liquidator of Better Limited account debtor, you need to pay how much? 15 lakhs. How you are paying? Equity shares, but out of which 10 lakhs in the form of face value, 5 lakhs in the form of premium. That is 2 equity share capital. 2 equity share capital, 10 lakhs. 2 securities premium, 5 lakhs. Next, still not it over, guys. Intercompany owings are there. If you observe, 1 lakh intercompany owing is there, right? In point number D, liabilities of Better Limited include 1 lakh due to Best Limited. What is the journal entry? Other liabilities account debtor. Other liabilities account debtor. 1 lakh you need to reduce. Now the asset is there under current assets. So to current assets account, 1 lakh. From the given heads holding, you need to reduce. If you check here, other liabilities given, here current assets given. Next, coming to the stock reserve issue, guys. All of you, in stock reserve, what happened? 50,000 worth of stock is there, na? So the 50,000 stock is representing at 125 rupees. Out of that, 25 rupees is the unrealized profit. 50,000 into 25 by 125, which is 10,000 is the stock reserve. The entry is capital reserve account debtor. Sir, you can debit the goodwill, na? If you want, you can debit the goodwill. But again, you are having capital reserve. At that point of time, you may set off. So that's why I'm directly debiting the capital reserve. So capital reserve account debtor 10,000 to stock reserve account 10,000. How you are getting this? 50,000 into 25 by 125. Entire discussion related to stock reserve I already made at the time of explaining theory. Now let me start presenting the balance sheet, guys, in schedule 3 format. Balance sheet of Best Limited purchasing company. Best Limited asset. What is the date given here? 1st April 2014. After amalgamation. Am I right? Now you know the format of schedule 3, right? In so many problems you are doing serial number, particulars, note number, amount rupees. Hope you know this format, all of you. You can represent the current year figures, that is more than enough. Now let us start with Equity and liabilities. Equity and liabilities. Under equity and liabilities, number one is shareholders fund. Under shareholders fund, A is share capital. A is share capital. So you can give note number one, but I don't want to provide any notes to save my time. But in the examination, you have to provide separate note. Concentrate. In bracket, I am mentioning clearly. Sir, existing how many number of shares are there? Existing, all of you in Best Limited, existing how many number of shares are there? That is 20 lakhs means 20 lakhs divided by 100 means 2 lakh equity shares are there. Is it 2 lakhs or 20,000? Sorry. 20,000 into 100 means which are 2 lakhs, right? 20,000 equity shares are there. Now, in the form of purchase consideration, how many number of equity shares issued? In the form of purchase consideration, number of shares issued as PC, how many number of shares issued? 10,000. That means the total equity shares after issue of PC becomes 30,000. Will you agree? 30,000 equity shares at the rate of 100 each, which leads to 30 lakhs. But in the note, you should clearly mention that existing number of shares, add number of shares issued as PC, then you will get 30,000 shares. Oh, sorry, here I'll write 30,000. But I'm not providing the note, guys, for the time being. She's 30 lakhs. Next, after share capital, B reserves and surplus. Sir, in case of amalgamation in the nature of purchase, reserves and surplus of the selling company will not taken over by the purchasing company. You can only see the reserves and surplus of the purchasing company, guys. Existing reserves and surplus 10 lakhs. Consider it. In bracket, you can put existing reserves and surplus 10 lakhs. Not it over. Now, if you observe in the books of purchasing company in entry number 2, you get capital reserve of 3 lakhs. In entry number 5, you debited the capital reserve of 10,000. The net capital reserve you have 2,90,000. You can add such net capital reserve here plus 2,90,000. Then the total reserves and surplus you have with you 12,90,000. But in note number, you should need to clearly provide opening reserves and surplus, add capital reserve arised during the process of amalgamation. Then you will get total 12,90,000. So the next issue is, sir, there are non-current liabilities not exist. All the liabilities I can consider as current liabilities. I can consider all the liabilities as current liabilities. Concentrate. In opening balance, how much current liabilities are there? 20 lakhs. Am I right, guys? Now you can consider the current liabilities of whom? Better Limited as well. Now you are acquiring the current liabilities of Better Limited. Current liabilities to other liabilities you are acquiring now 2 lakhs. That's why you can add here 20 lakhs plus 2 lakhs. One more thing, not yet over. Is it intercompany owings? Other liabilities decreased to the extent of 1 lakh or not? That's why you need to reduce the intercompany owings as well. In notes to accounts, how you should need to present, you know, existing other liabilities 20 lakhs. Add the liabilities of Better Limited 2 lakhs less intercompany owings 1 lakh. Then you are getting total 21 lakhs. Like that, you need to present in the notes to accounts. What is the total here, guys? Can you please tell me? 30 plus 21, 51 lakh plus 12 lakh 90,000, which 63 lakh 90,000. Am I right? Next, you can go to assets, guys, here. Number 2, assets. Under assets, first one is non-current assets. Non-current assets. A, property, plant and equipment. Please, all of you concentrate here. Here the fixed assets are inner 25 lakhs plus you are taking the fixed assets of Better Limited as well now 15 lakhs. There are no other adjustment. Simply you can put it as 40 lakhs. Next, what is the next item? Investments. So let us assume all the investments are non-current investments. Non-current investment. Only Best Limited have the investment. You can put the same investment of the Best Limited in the balance sheet, which is 5 lakhs. Next, Coming here to the current assets. Number 2, current assets. So opening current assets, how much? 20 lakhs. Plus, what are the current assets of Better Limited? 5 lakhs. As an intercompany owings, how much I need to reduce? 1 lakh na? In intercompany owings, journal entry, you need to reduce from assets as well as liabilities na? Please check all of you here. Other liabilities to current asset. Current assets need to decrease 1 lakh. One more thing, guys. To stock reserve, you wrote na? This stock is there under which assets? Current assets only. That means stock reserve is nothing but reduction in the stock. That stock is there under current assets means you need to reduce the current assets as well, 10,000 for stock reserve. Minus 10,000. This is for stock reserve, guys. Now you can tell me how much it is. 24 lakhs minus 1 lakh, 24 lakhs, 24 lakhs minus 10,000, 23 lakh 90,000. What is the total? 45 plus 23 lakh 90,000. I got 68 lakh 90,000. Is it matched? Oh, where the 5 lakhs difference, guys? Can you please check, guys? All of you? Anywhere, any mistake? Any reserves and surplus ignored by me? What happened? Please let me know through chat box quickly, guys. Anything ignored by me? Sir, you are not taking securities premium. I think so. Securities premium not considered. You are absolutely fine, guys. You are absolutely right. Yes, securities premium is there here, which is 5 lakhs. You can increase. That is the difference. So securities premium, you can add it. Just now I found that securities premium I ignored. Anyway, balance sheet not tallied. Now I am rectifying, which is 17 lakh 90,000. So the total is 68 lakh 90,000. Now it is tallying. Am I right? This is the end of problem number 5, guys. Now concentrate, guys, all of you. I'll give the next problem as an HW problem. Why I am giving problem number 6 as HW, I will tell you. Please concentrate. What they asked that final. Please come, all of you, final point. See, prepare ledger accounts in the books of K Limited and L Limited to close their books. Just they're asking, prepare ledger accounts in the books of K Limited and N Limited to close their books. Sir, to close their books means maybe they are asking accounting treatment in the books of selling company. Two companies are there. One is K Limited, another one is L Limited. So the purchasing company is LK Limited. The purchasing company is LK Limited. If you observe, K Limited and L Limited amalgamated to form a new company called LK Limited. LK Limited is a purchasing company. K Limited is one selling company. L Limited is another selling company. 5-step approach you need to complete in K Limited. 5-step approach you need to complete in L Limited. That is the thing actually they are asking. But before proceeding with 5-step approach, you need to calculate purchase consideration. That is the crucial role in this problem. PC is under which method? Let us have a look. Concentrate. PC is under which method? Now concentrate. I'll read the point number 2 and point number 3 here. Again, yeah, point number 2 and point number 3 are enough. I'm not doing the problem from my side. I'm giving the HW, just I'm giving hints how to do the problem. Issue of 5 preference shares of rupees 20 each in selling company. Sorry, in LK Limited is purchasing company now. Issue of 5 preference shares of 20 each in purchasing company at the rate of 18 paid up at a premium of 4 rupees per share. That is total 22 rupees per share for each preference share held in both the companies. That means for L Limited we are giving 22 rupees per share. For K Limited also we are issuing 22 rupees per share. For each preference share we are issuing 5 preference shares. Issue of 6 equity shares of 20 rupees each in LK Limited at the rate of 18 rupees paid up at a premium of 4 rupees per share, again which is 22 rupees per share. Now we are issuing 6 equity share per each share for each equity share held in both the companies. In addition, necessary cash. In addition, necessary cash. If you observe here, in addition, necessary cash should be paid to the equity shareholders of both the companies as required to adjust the rights of the shareholders of both the companies in accordance with the intrinsic value shares of the both the companies. Can you please tell me, guys, all of you, what is the method of PC in this problem? All of you, please respond quickly in the chat box. All of you, please quickly respond in the chat box. May I know what is the method of PC? Nobody is responding here. Quickly, guys. I'm seeing the chat box. Nobody is responding. Can you please quickly? Just I want to know the method of PC. What is the method of PC here? Please think from your side. I'm giving time space to you. Net asset value. Net asset value. Net payment. Someone is told net payment. Someone is telling intrinsic. Someone is telling net payments. So the persons who told net payments method is absolutely wrong. The persons who told net asset value method or intrinsic value method, both are correct, because there is no difference between intrinsic value method and net asset value method in this problem. Do you know why? Sir, after reading the problem, if you are unable to ascertain how much amount payable to the equity shareholders, then the method of PC is not net payments method. But we can consider that the overall method is net payments method. I will agree that. I only ask amount payable to equity shareholders, which method? Amount payable to equity shareholders is NAV method. And the overall method is net payments method. Overall method is net payments method. Amount payable to equity shareholders is net asset value method. This is a combination method. So the exact answer is persons who told the answer as combination. Some persons told, sir, which is a combination method, sir. We can't tell like that. Yes, that's absolutely correct, ma. What you said is absolutely correct, which is combination of more than one method, which is involvement of net payments method as well as net asset value method. Or you can call it as intrinsic value method as well. Okay. Sir, first what I should need to do? First, what you should need to do, you are unable to ascertain amount payable to equity shareholders, right? You are unable to ascertain amount payable to equity shareholders, right? First, you should calculate net asset value of both the selling companies. You should first calculate net asset value of both the companies. With such net asset, where it is here, I'll only show working notes. Concentrate. So purchase consideration overall is net payments method, payable to preference shareholders, payable to equity shareholders, payable to preference shareholders, payable to equity shareholders. Preference shareholders we know directly, but equity shareholders we don't know directly. Equity shares how much we are paying we know, but cash how much we are paying we don't know. For that purpose, we calculated net asset value method. Under net asset value method, if you check 15,60,000 you got for K Limited, for N Limited you got 7,90,000. Now, out of this net asset value of 15,60,000, you know already in the form of equity shares how much, which is 10,56,000. So in the form of equity shares, so sorry, here print mistake may be there. This is 14,56,000. Just a second. No, just wait. Just a moment, please. So which is 15,60,000, right? Concentrate, all of you. The NAV total is 15,60,000. Out of this, you already know in the form of preference shares how much, equity shares how much. The remaining is in the form of cash. In the form of preference shares is how much, guys? 4,40,000. Just a second. In the form of preference shares is 4,40,000. In the form of equity shares how much? You got in the form of equity shares at the rate of 22 rupees per share. Sir, 6 equity shares we are issuing while reading the problem I told. So which got 10,56,000. Now the remaining balancing figure is in the form of cash. That is 15,60,000 minus 4,40,000 minus 10,50,000. The remaining balance is in the form of cash, which is 64,000. For that purpose, you calculated the NAV. Amount payable to equity shareholders You cannot know directly because cash component is also involved in such that's why the cash component is a balancing figure. In the same thing, out of 7,90,000, you can segregate in the form of preference shares, you can segregate in the form of equity shares, you can segregate in the form of cash. Cash is the balancing figure. You know amount in the form of preference shares, amount in the form of equity shares. Already you know the balancing figure is cash. For that purpose only, you are applying the net asset value method. Okay. Are you with me, guys? All of you? Are you with me? Do you understand? Can you do the problem from your side as an HW? So please complete all of you this problem and homework, guys. Okay. Next. Sir, I unable to start the next problem at this stage, but I will tell you one thing. I will take one thing for the discussion. Please concentrate. What we are discussing, I'm going to discuss amalgamation in the nature of merger. Please concentrate. Within 5 minutes, it is over. Amalgamation in the nature of merger. You know, if the amalgamation is amalgamation in the nature of merger, what is the method of accounting treatment we are going to adopt? Pooling of interest method, right? Pooling of interest method. Now concentrate, guys, all of you. Sir, what is the difference between amalgamation in the nature of purchase and amalgamation in the nature of merger? The word pooling of interest method clearly telling that you should simply add line by line assets as well as line by line liabilities. Why? Because purchasing company is ready to take over all assets at book value. Purchasing company is also ready to take over all the liabilities of selling company at book values. Simply, for example, if you thought that this is the balance sheet of selling company, then what are all the different assets it have? All the assets I should take over at the rate of book values only. And all the liabilities also I will take over at the rate of book value only. One more shocking thing here I am telling. Purchasing company will not take, purchasing company apart from assets and liabilities of the selling company, it will also take over reserves and surplus as well, guys. Reserves and surplus. Sir, pooling of interest method means the selling company is not a other entity. It is just a sister concern to me. Selling company is just an extension to the purchasing company. Now, if you really remember the concept of external reconstruction, what will happen in case of external reconstruction? A new company is incorporated to take over the existing business. I mean to say, almost all the shareholders of the selling company should become the shareholders of the purchasing company. That means the reserves and surplus which are existing in the selling company should also belongs to the reserves and surplus of the purchasing company. Why? Almost who are all the shareholders exist in the books of selling company are also become the shareholders of the shareholders of the purchasing company, means there is no change in the shareholding pattern. Who are all the shareholders of selling company? Are the same continue as the shareholders in the purchasing company. That's why there is no difference in between shareholders of selling company as well as shareholders of the purchasing company. That's why the reserves and surplus of the selling company should also belongs to purchasing company. That is the only special point, guys. What is the special point? Assets and liabilities taken over. All assets and liabilities taken over at the rate of book value. You know that. Apart from this, purchasing company is also taken over reserves and surplus. This is the important thing you have to remember in case of amalgamation in the nature of merger. Now, the next question coming into my mind is, sir, amalgamation, the type of amalgamation is only applicable in the books of purchasing company now. Then what are the adjustment need to provide in the books of purchasing company? First entry is as usual. I mean business purchase to liquidator of selling company at the rate of PC. PC will not change. Method of PC is always, the discussion of PC is always same, whether the amalgamation is amalgamation in the nature of purchase or amalgamation in the nature of merger. you know, you will find out the method of PC, that is net payments or net asset value method or intrinsic value method or lump sum method. Accordingly, you will put that figure. That's okay. Now in the second entry, always what you should need to do, you should compare net asset value of the business with purchase consideration. Will you agree? You will compare purchase consideration with net asset value of the business takeover. Now, can you please tell me, all of you, what is the net asset value of the business takeover here? You are taken over all assets. You are taken over all liabilities, including the reserves and surplus. You are taken over assets minus liabilities minus reserves and surplus is the net asset value method. Assets minus liabilities minus reserves and surplus means I can put share capital of the selling company as NAV. Will you agree, all of you, this point? What is the NAV of the selling company? NAV of the selling company in case of amalgamation in the nature of merger is share capital of selling company. Will you agree? Because I am taken over all assets at book value. I am taken over all liabilities at book value, including the reserves and surplus of selling company is also taken over by purchasing company, means the remaining figure in the balance sheet is only share capital. So on behalf of adding assets and reducing liabilities and reducing reserves and surplus under NAV, you can directly put share capital of the selling company itself is NAV of the selling company. That means at the time of comparing purchase consideration with NAV of the selling company, I can directly compare purchase consideration with share capital of the selling company. One more, you know, in case of amalgamation in the nature of merger, the entire purchase consideration in the form of fully paid up equity shares only. Fully paid up equity shares only. Then the worth of equity shares I am going to issue should need to be compared with share capital of the selling company. Then the next question is, sir, if PC is greater than NAV, if PC is greater than NAV, what I should need to do? If PC is less than NAV, what I should need to do? That is, the purchase consideration is greater than share capital of the selling company, what I need to do? The purchase consideration is less than the share capital of the selling company, what I need to do? That is suspense. We will discuss such issues in the next class, guys. Before coming to the next class, please all of you complete the ICAI Limited problem as a given HW. So I will continue the discussion amalgamation in the nature of merger. So what happens if PC is more than NAV? What happens if PC is less than NAV? Hope most of the doubts are clarified in the today's session during the revision process or at the time of conducting the problems. So still, once if you are habituated to doing such problems, then you will get good grip on the entire chapter amalgamation. Still, if you have any doubt, I am free to resolve your doubts. You can send a proper mail. I will resolve your doubts, guys. Bye-bye. Have a nice day. We'll meet in the next lecture. I think so the next lecture may be the tomorrow itself. Okay. Thank you. Bye-bye. Yes, sir. Yes, sir. Yes, sir. You can close that.